Channel outdoors. I'm here to show you about stock market today. The U.S. has all three major indexes closed lower for the week. S&P index falls for fourth straight week, and all three major U.S. indexes recorded losses. The market is evaluating the earnings report from tech giants like Apple and Amazon. The non-farm payroll data for July fell short of expectations and hit a 32-month mark, with the unemployment rate falling to 3.5%. This week, investors ushered in intensive earnings report. Amazon jumped 8.3% as the company announced earnings as beat expectations and provided positive guidance. Apple closed on 4.8% with its market value below $3 trillion, and the company closed Thursday after announcing revenue below year-ago levels. Airbnb reported lower than expected growth. DraftKings announced results that beat analyst expectations. To date, 84% of S&P 500 companies have reported results, and 80 of them have exceeded expectations. In addition to earnings reports, traders are closely watching Friday's non-farm payrolls data to gauge the strength of the labor market and the U.S. economy, as well as its impact on the path of Fed's monetary policy. The U.S. Department of Labor reported on Friday that non-farm payrolls rose by 187,000 in July, a 32-month low, lower than expected of 200,000. The unemployment rate recorded 3.5% in July, compared with 3.6% in both previous and expected. The average hourly earnings in July were unchanged from the previous value of 4.40%, 0.2% percentage points higher than expectations. The Labor Department also revised down the number of new non-farm payrolls data in U.S. to 281,000 in May from 306,000, and the number of new payroll data in June to 185,000 from 209,000. After the revision, the combined number of new jobs in May and June was 49,000 lower than before the amendment. Among the unemployed, temporary layoffs were 667,000 in July, then 175,000. The Labor Department said the number of permanent unemployed was little changed at 1.4 million people in July. The number of long-term unemployed remained at 1.2 million people, or 19.9% of the total number of unemployed. Analysts said that the non-farm payrolls data showed that the U.S. labor market remained relatively tight. The unemployment rate stabilized near decades low, and wage growth remained at rapid growth rate. Last month's data showed resilient consumer spending and a sharp slowdown in annual inflation in June. Economists have been predicting a recession in the fourth quarter of this year, and they're now increasingly convinced that the Fed scenario of soft landing is possible. Sam Bollard, senior economist at Wells Fargo, said, "There are signs that labor demand is slowing, but it's not a cliff-like decline." But he thinks year-over-year wage growth remains too high to align with the Fed's 2% inflation target, but it'll be the latest signs that the wage pressures continue to fade in the third quarter. Wage and unit labor cost growth slowed in the second quarter. Economists who have long predicted a downturn in the fourth quarter of this year are increasingly convinced that the most aggressive rate rising cycle in more than 40 years may be over. Since March 2022, the Fed has raised its policy rates by 525 basis points. Inflation has weakened sharply, and the marked slowdown in U.S. labor costs in the second quarter, while other data such as GDP, productivity, and consumer spending have recently been surprisingly strong, fueling optimism that the economy can avoid a recession. Analysts said the report supported the Fed's case for pausing interest rate hikes in September. July's surprisingly low non-farm payrolls and a downward revision to June's data reinforce the view that the labor market is divergent. More important to the Fed's considerations ahead of the September FOMC meeting is the wage growth data. Our average hourly earnings have been risen unexpectedly, but weekly earnings have grown very slowly due to the few hours worked. All in all, the report provides some support for the Fed to pause rate hikes in September. The U.S. fiscal situation is in the spotlight this week. The market struggled to digest the news that the U.S. Treasury was expected to borrow $1.007 trillion in the third quarter, a record figure for the same period and an increase of $274 billion from the May estimate. Fitch rating agency unexpectedly downgraded the U.S. credit rating on Tuesday, as the market is looking towards the U.S. Treasury announcing the size of the U.S. bond offerings to reflect soaring borrowing demand. This means that the U.S. is no longer an average AAA rating. Fitch said the deterioration of the U.S. fiscal indicators was one of the reasons for the downgrade, and it expects the fiscal policy to continue to deteriorate over the next 3 years. That's all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.